All-time high, baby. We finally nailed it. The S&P 500 closing at 48243 on Friday, January the 19th, 2024. Over 500 days since the last all-time high hit at the end of 2021 into 2022. Congratulations. By the way, this is the sixth longest time in between all-time highs going back to 1928. The sixth. So for those of you bears that are expecting or did expect a deeper, steeper, longer term pullback, I have some bad news for you. Statistically, it's not going to happen. We're going to dive into that in today's episode. My name is Hamilton. I'm here with the Trading Initiative. Please like and subscribe if you like this type of content. Leave a comment below. And without further ado, let's get into it. First things first. Everybody right now is talking about this idea of a double top. A double top. Watch out, the double top. The indexes are looking a lot like they did in 2000 and 2007. This type of stuff is everywhere. It's already on FinTwit. It's already on YouTube, Let me tell you something. If last year didn't prove it enough, it's that doom porn and prepping for the eventual failure of the financial markets is a very good way to fucking lose your money. Do not bet against the long-term trend, which we're about to see in a second, is up. Okay? If you're betting against the downfall of the market, you're statistically taking a very short-sighted viewpoint because over the long run, the market continues to go up over time. So first things first, I just want to point out, no hate on any of these guys that are posting these types of charts. I get it. It's scary out there, right? It's scary, specifically if you're not long at all-time highs. You definitely want the market to pull back, therefore giving you either an opportunity to get long or to make a couple bucks on the short side because you probably haven't made that much money over the last year being short. All right, so this idea here from 2000 to 2007, which we're going to go through in a second, a potential double top. And as you can see into 2007, that GFC, the Great Financial Crisis, the market came down, broke below the dot-com bubble lows, and absolutely sent the financial world in a tailspin. Let's go ahead and look at the next one here that just came out. Once again, another person kind of comparing the 2000 and 2007. This is very popular right now on FinTwit and YouTube, kind of throwing out these ideas that maybe there's going to be this epic drop down. And guess what? It might actually take out those COVID lows just like it did back in 2000 and 2007. Can you imagine what the markets would look like right now if we started to break down and threatened a total financial market failure below the 2020 lows? That would be pretty bad, but I'm here to kind of burst that bubble. All right. And you don't have to look any further than this chart in particular from Bank of America Global Research that shows you the difference between secular bear markets and secular bull markets. All right, guys. Now let's take about 2 minutes and walk through this. I know it's kind of complicated, but generally when the arrow's going up, it's a better time to buy than short. And when you have these little boxes, it's probably better to play a little bit of defense. First things first, secular bear markets tend to last about 10 to 15 years. As you can see from 1937 to 1950, bear market. Why? Potentially Great Depression, World War II, big global events that shaped the global financial markets. Totally understandable. All right, let's move on to 66 to 80. Once again, about 15 years there. What was going on? We had Vietnam. We had the 70s stagflation crisis, the Great Divide, OPEC oil crisis, etc. Lots of stuff going on there. The hippie movement, which has now actually been proven to have impacted the global financial system for the worse, but that's okay. Society as a whole potentially got a little bit better. And then the last secular bear that we've been in over the last 100 years from 2000 to 2013, well, we had the dot-com bubble blow up followed by the Great Financial Crisis. Both of those distinctly different. Dot-com bubble, and then the GFC was real estate and financial derivatives, right? So if you can tell, 13 years, 14 years, about 15 years-ish, right? That's kind of the idea here. Generational lows, 42.74 in 2009. I get it. It's scary. Those were the best times to potentially be buyers, and it was very hard to buy back then. But after a secular bear market, you have a 15 to 20-year run in a secular bull market. We have from 1950 to 1966, a nice 16-year run. We have 80 to 2000, a 20-year run, and we have 2013 to current year of 2024, which is only 11 years. 15 to 20 years on average over the last 100 plus years of these secular bull markets. And as you can see, by the way, in secular bull markets, you still get drawdowns, you still get corrections, you still get recessions, and you still get bear markets, but it's within a broader uptrend. So you get cyclical bear and bull markets inside of secular bear and bull markets, but the overall trend is to the up in a secular bull market. And in 2013, we started our secular bull market as we broke out up and over the 2000 and 2013 highs. we still have, going back 100 plus years with this type of model, another 6 to 10 years of a secular bull market. Now, they also appended here the times between major drastic pull downs. At the time, it felt like the world was ending. You can see 36 months between the 87 and 90 lows. You see the 2000 to 2022 lows, 31 months. You see 36 months between the 57 and 1960 lows. So you can see that these lows are kind of bunched up. I'm sorry to tell you, if you're a bear, this low is bunched up with this low. It follows the exact same pattern over the last 100 years. If you're expecting new lows to happen, essentially what you're saying is, well, this time is going to be different. Isn't that something that bears love to say? Well, if you expect the market to go up more, you expect it's going to be different this time. Don't know what to tell you, boys. But you expecting new lows in a secular bull market after we just had a 31-month difference between the 20 and 2022 lows is legitimately expecting something different. I am on the bull camp, firmly in the bull camp, by the way, for 2024. Not only are we inside of the fourth year of the presidential election cycle, which is generally the second most bullish year within that 4-year period, we also have a sitting president seeking re-election, which ups the antes on average, going back to 1949, of a bull market moving between the index is moving between 10 and 15% on the year. The S&P 500, NASDAQ, and the Dow are probably going to move closer to double digits to the upside than not, based off of stats going back to 1949 during the fourth year of a presidential cycle, plus a sitting president seeking re-election, plus a secular bull market, plus an all-time high. If you're looking to short this from a macro standpoint, all of the data is going against you. All of it is going against you. Now let's talk just from a pure TA standpoint. Well, it's a double top, right? We have all-time highs, so obviously we have some sort of resistance area being hit. Well, Bukowski, obviously, I always want to tell you guys that you should go and verify. Don't just parrot whatever the fuck everybody else says. They're usually fucking stupid and wrong. Go and actually look at the stats behind the chart patterns that supposedly you think are going to play out. Bukowski just did that. 942 perfect trades. He obviously outlines exactly what he's looking for in these double tops, so you can go ahead and verify that. But over 942 trades, this is middle of the pack in a bull market. Middle of the pack. As a matter of fact, there's only a 43% chance that if it actually does break down, it's going to hit its price target. That is not a very impactful trade. So not only are you trading against a secular bull market, you're trading against a primary trend to the upside that has been in place since October of 2022. I don't give a shit what you think. This is a primary uptrend, up 35%. You are also trading an underperforming chart pattern. If you want to take this trade and it works out for you, you'll probably make a lot of money. Let's be honest with you. It has a very low winning percentage, but when it does work, it makes a lot of money. The problem is it doesn't work very often, and you have a lot of things moving against you right now if you expect the market to hit new lows. Once again, I'm not saying that we're not going to pull back. It's not going to be choppy. It's whatever. But what I'm saying is there is very little chance, based off of 100 plus years worth of data, going back to the secular, bear and bull, and the presidential election cycle stuff, that we now have a very large chunk of data and stats to go along with that to back that idea up. That video is going to come out shortly, by the way. But we also have the fact that you're trading an underperforming chart pattern. Once again, go look at it. thepatternSite.com/EEDT.html. Go look at it. Go look at the stats. Once again, doom porn sells, but it doesn't make you a whole lot of money most of the time. So choose which camp you want to be in. Bull side or bear side. Be okay with being wrong in the short term, but in the long term, bulls have always won. If you like this type of comment, please like and subscribe. Leave a comment below, and I'll catch you in the next one.